mainly in Asia, so good afternoon to you guys. It's a good morning for me. Oh, we got quite a good number in the room today. So we are going to talk just a little bit about the markets and I guess a little bit about what's been happening. We know, maybe we don't, but we'll talk about a bit about what's driving some of the markets, and we will talk about what might happen next week. Now, as many of you know, I have my main, I guess, skill set is kind of reading data. It's reading fundamental data, it's reading seasonal data, and it's reading COT data. And I can tell you this week that the COT data particularly is relatively unclear. The only things that it's kind of pointing out this week is possibly some pound weakness, and I'll explain possibly in a moment, and possibly some CAD strength. Seasonal data is almost flat right across the board. There's a little bit of, I guess, indication that that the likes of the Kiwi dollar and the Aussie dollar might still find some weakness, and maybe a little bit of strength in the yen, but it's pretty flat. And the fundamentals are going to be about what is not already known, because we know really what's happened with Japan is that the Bank of Japan have raised interest rates very slightly, but recently they've said that that's going to be the last one. Now it's going to be whether the market trusts them or not. However, the caveat is if they hold interest rates at the current level, which is at 0.25%, which is very low, there is the carry trade. Now, does everybody understand what the carry trade is? Or does it mean not understand what the carry trade is? Let me know if you don't understand what the carry trade is. I'm just going to set up my screen. Not really. Great. Okay. Thank you, Yasin. Okay. All right. Well, let's have a look at the carry trade, because the carry trade is really important with what we've got going on right now. Now, what I need to do is just bring my pen somewhere else. Let me see if I can do this. There we go. Right, what I want to do is let's go for this one here. And we're going to go here, 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 and here. And that's okay. Right, let me share my screen and explain the carry trade. Let's do it on whiteboard. Right then, so the carry trade is, so let's say you have a Japanese bank. Over here. And we'll use the US because it is the most common carry trade description. Sorry, US bank here. Now, the Federal Reserve over in America and the Bank of Japan over in Japan set the interest rates. And when they set interest rates, that affects the lending from retail banks. So if the United States, if the Fed are setting an interest rate of, if the Fed is setting an interest rate of 5%, let's say for an example, they set an interest rate of 5%. Now that's not the accurate description right now. I think it's 5.25%. But let's say the Japanese have got an interest rate of 0. Or even in some cases, -0. But let's say that they do this. Now that means that you want to borrow over here. Now a retail bank might add an extra couple of percent, but they're not going to add 5%. But let's say you want to borrow over here. Let's say you're just going to borrow directly from the BOJ. You want to borrow here. Let's say that the borrower borrows $1 million worth of yen over here and exchanges it over here. So that $1 million comes over here. Now that $1 million is going to earn the person who's borrowed at 0, 5%. Okay, so that's the carry trade in the most simplistic form. That's what's going on. They borrow in yen, they convert it to US dollars and go and stick it in US treasuries, which is effectively an interest rate that the central bank pay. That's the carry trade, the easiest way to make money for any trader, because they don't even have to pick a stock. It's quite simple. They borrow in one area, and so the big kind of conglomerates and the big organizations are able to do this because, of course, they've got exposure to yen, because they will have currencies all over the world, because they are doing different trades in all over the world. If you want to buy Japanese stocks, the first thing you have to do is convert your currency, your base currency, into Japanese yen before you buy the Japanese stocks. So what would happen in this example is you may borrow money from the Japanese bank, then take it out of there. So cutting the demand for the Japanese yen and putting demand on the US dollar, because you are going to get a 5% return. Now, what that does is it pushes the US dollar up and it pushes the Japanese yen down in value. So that's the carry trade. Now, what's been going on is the carry trade is unwinding, because as this starts to come down or go up, actually, let's say that it's going up instead. So this one's gonna start going up in value, and they're now lending out at 0.25%. And this one's currently the same. However, in September, they believe, now this is at 2.5, I think. And we'll double check that, but I don't want to give you misinformation. Let's make sure that misinformation isn't in play. By 5. I'm getting tied up with what's happened in the UK. So in the UK, they've just lowered the interest rate from 5.25. So what we've got going on at the minute is that this is paying 5.5, as Yasin says, absolutely right. This is paying 5.5. Now, the unwinding happens when in September, they're going to assume that this is going to pay 5.25 if they lower interest rates. Now, what that means is the value between the two currencies needs to be recalibrated. So whenever you buy, if you buy something, as you buy $1 here, and it's going to be paying 5.5. If this goes down in value, then to retain the same percentage, the value of the dollar has to come down in value as well. That's what traders are going to try and do. They're going to try and get the same value. So they will weaken the price of a currency. That doesn't mean it's going to go to parity. They're not going to go to 1-to-1, but the value of the yen has just gone up in comparison to where it was today. So the price today is not the same value as it will be in September, as an example. So as the carry trade unwinds, it pushes the Japanese yen up in value and the dollar down in value. Does that make sense to those people that didn't understand the carry trade? You're basically borrowing cheap, and your returns are, a decent value. Really, really simple, and it's practically with no risk. So that's the carry trade. Now, what's happening is, yeah, much clearer, great. Okay, so what's happening is, what we've seen is the dollar, as the yen has kind of gone up. Now, what the fear was that it would start a cycle with the Bank of Japan to continue to raise interest rates. So every time they raise interest rates, it changes the value of the yen. And that's why people will be sort of trying to buy in front of that change in value, because by the time it's reported, then it will be at fair value in balance with the interest rate paid. So that's why people buy early. That's why people, as traders, we are effectively betting, and I know that's a dirty term for many people, but you're always making a bet effectively, because you are using the information on offer and making an assumption, and that's what a bet is. Being a good, what we're trying to do is be good at betting effectively, good at betting what's going to happen next. But you do this right the way through your life, in no matter what field you're in, you're always making a bet about what's going to happen. So what traders do is bet on what the next move's going to be, and that's when they go and start looking at the intra country data, if you like. So things like PMIs, unemployment, retail sales, CPI, inflation, and all this sort of thing, to try and make an assumption on what the next move of the bank's going to be, because that changes the value of the currency. Now, the idea really at the minute is that the Fed are going to be lowering interest rates, and the Bank of Japan are going to be raising interest rates. Now, the Bank of Japan have come out and effectively said, look, that's not going to happen. We're not going to raise interest rates anymore. But the effect initially was quite palpable, So when we look down here and we look at this on support, what we next need to say is, will this particular support line hold? Now, the support line will hold if fair value is where we currently sit. If the action from the central bank is going to change and put the currencies out of balance again, then the price will change. So when I look at this, particularly on the dollar yen, this is an extremely aggressive move, and you will find this quite a lot. You will see an extremely aggressive move, and as more information comes out, either this will stabilize and go higher, or it will continue to gather pace and gather momentum and continue to drop lower. So when I look at this chart, this particular chart here on the dollar yen on the weekly, if there's, we can look on the monthly, but we're really sort of like, we're now into the month. So when we're sort of looking at this last month at the end of July, the suggestion here is that we would see some downside, and that's now happened. We saw a big collapse from 150 right the way down to around about the 142, 141 mark down there. So this has already had a bit of a collapse. So last month's bar indicated that at some time during August there would be a sell-off, and that's now happened. Whether that sell-off continues or not is the next question that we need to ask ourselves. So we need to break these up now into week on week. Now, week on week, what we've got with the dollar yen is a trend line. Can you guys see my chart okay, by the way? Because I'm happy to change the color here. But if you can't see it, just let me know. What we see here is a trend line. You can see it, great stuff. We see a trend line and price under the trend line. So if we're sort of like having a look at this, what we're sort of effectively ascertaining here is, where is support and where is resistance? Now, the first point of contact here is going to probably be, now we're right on top of this horizontal line, which has just managed to find some resistance. But really, the first point of contact is going to be here, along there. And that's good. That's a little bit of a horizontal level as well. I don't know how far back that goes. Oh, look, it's pretty good, actually. So there's a horizontal level along here. So if we are long-term traders and we are buying the dollar yen, our first point of concern is going to be the 148.50 level. It's currently at 146.60, so in and around. So our first point of concern is going to be here. From a long-term perspective, if we had to trade this whole bar, there's no money in it. The risk to reward is rubbish. But what we can then do is start to come down in time frame, and that's where, if I look at this chart now, if we look at on the daily's still not a lot of room if we're going to sort of try and trade this to the upside for a bit, or alternatively, we could look for sell signals in this area and see if it will come down. Now, the only reason I would suggest that we might be looking at buy signals first is to do with the weekly bar. You know, this weekly bar is a hold. We're right on top of support here. We've tested this area of support. We've tested this area of support in and around. It's probably this one here, actually. We've tested some areas of support and we've rejected them. So that suggests that there's buyers down here. Now, intraday is going to be tough to go long, but the weekly bar suggests that there could be some buying here. Now, when I look at the COT data and the seasonal data, they kind of back up the fact that we might hit a bit of a range, which suggests that we might well see this particular price point at some point next week. It doesn't mean we're going straight up, but it suggests that at some point this week, we're going to see 148.50. So then the question, if when we come down is, you know, can we get an intraday signal to get us into the trade? Now, this at the minute looks like it might be a little bit negative. Maybe in this area here, we'll have to use pivots and stuff like that to make a judgment call. But choosing the direction is really the first job for us. And the data suggests at this stage that the direction is uncertain, which means we can go long or we can go short, but we've probably got to trade it on an intraday basis. And if we do that, that would suggest that at the very worst, this is going to hold. So longs are going to be potentially in play right the way down to the double bottom. And that's maybe what we need to see first. You know, might be better to wait for the short to come down here, then go long. Or if the market goes up to this point first at the start of the week, we might well be looking for sell signals to see if it will retrace a little bit more, you know, start coming back down again. So that's the dynamic that we've got going on this week. You know, where are we? Are we in fear or are we in confidence? Sorry, I'm just to read this. If the Fed reduces the rates on September, will this cause more downside for the dollar? Yes, it should, Yasin. However, if the Fed are assumed to reduce interest rates in September, that particular move will happen a lot sooner than September. The ATW4H news editor on subscription. Is this good for daily wave rider trades? Previously, you had mentioned it was more H1 lower. Oh, well, do you know what, LS? I will have to look back over the data for that. I'm actually doing a bit of a test on it right now. But Paul said to me recently that after the last 8 trades of daily wave rider, 6 of them would have benefited from the newsletter. So, so I think it is. But I'm going to have to go. That's only what Paul's told me, and I'm not somebody that takes what somebody else says as gospel. I prefer to do my own research. So I am researching it at the minute, but it's quite involved. So I'll be able to answer that better as time goes on. Sorry, I can't give you a definitive answer right now, but my belief is that it is, but I can't say with absolute certainty. You're welcome. Love the US dollar. Oh yeah, cool. No, we don't know. No, this is the thing, Catherine, and I guess this is the point. We never know. But what we're going to do next is have a look what might drive the price and what direction it may well go in. Okay, so the next thing that I'd want to do after seeing now, if COT data was explicit, and I can tell you for one thing, COT data was absolutely explicit on the rally in the yen. However, it didn't give us timing. What the COT data has been explicit on a rally for the yen ever since this period, probably ever since this period. And we had a big dip. It rallied. The dollar rallied, so the yen weakened again, and all the way through this period, the yen was suggesting that there would be a rally on the yen and a tank in everything else, versus the yen, and that's happened. Whether that's unwound is the next question. And I can tell you again, from what COT data is saying, this particular trade is unwound. Not fully, because the yen is not negative, but it's bang in the middle. So what that's now saying is that traders are satisfied with some of the positions that they're in. You know, they're not starting to build yen shorts, but they're not building on those yen longs. So the ones that are in look like they're holding the position. So that suggests some messing around in this area. But the ones that aren't in aren't building on a position to go short. So that does suggest that we might well see some further price action here. And when I look at this, my eye, generally speaking, and it's my default setting, generally speaking, is drawn to Head and Shoulders pans. Now, it doesn't mean it's because it's the most successful. It's just that, you know, when I was learning to trade, I think the guy that was teaching me he loved Head and Shoulders. So I've ended up seeing him. Now what I see here is a left shoulder and a potential right shoulder along here. And that suggests maybe, you know, we could come down, we could come up. We could mess around in this area. And that says attempt to pick the extremes. If it comes up to the trend line, look for a sell-off. If it comes down to this low again, look for buying opportunities, but don't expect big long trends. Yeah, I would, Linda. I don't think, you know, when we're sort of making any, so throughout our week, we've only got 2 decisions to make initially. Every trader's got two decisions to make. Do I trade it or do I not trade it? Do I initiate a trade or do I not? That's the first 2. After that, it's like, where do I get out and all that stuff. I've got to be honest, when I look at this week, my default is, and there's nothing wrong with not trading. I know sort of from a new trader's perspective, it's like you've got to be in the market, you've got to take advantage, you know, you've got to participate. You actually don't. You know, not taking a trade is a decision. Not taking trades is a decision, and it's a good decision if the market doesn't look like it's going to shape up. Now, what that says to me is, if the price is right, it's worth a punt. You know, if the price isn't right and it's sort of in between, unless the signals are really strong, it may not be worth it. So I might not be looking for trades at all this week. Well, I'll be looking, but I might not initiate anything this week at all, because the COT data is so benign and the seasonal data is incredibly benign. It's just, and I say incredibly because it's rare that you see this kind of stuff. Now, with the CAD and the pound, there's a little bit more, detail from the COT traders. And what they are suggesting is pound weakness, CAD strength. However, the reason that I don't 100% trust it is when I'm looking at COT data, I like to see positions build. So what you'll get is this. Now it's all kind of done in contracts. So COT data is like, you know, the amount of contracts. So let's say you've got the pound. Now these are all done in their own box. They're not done in pairs. They're not trading pairs. It tells you about what's going on with the pound. Let's say you've got 1,000 contracts that are buying. Okay, these are buyers, and you've got 900 contracts that are selling. That means there is a net plus of 100 contracts, which on the face of it is quite bullish. Now, what we look for in COT data is our extremes. So if we look through historically, that 100 buying contracts doesn't tend to move the pin very much. We won't take much heed in that. But if the net contracts were more like 900, because this is at 100, then that might well send us a positive signal. And we say, okay, well, you know, people are buying up aggressively the pound. We should be looking for buy signals. That's what's been going on with the yen. Now, what's happened recently is that with the pound, there's actually a net deficit. So that the sellers are much more, they see the risk on the sell side more than they do on the buy side. So let's say the net contracts at an extreme are 1,000. Now, what I want to see from one week to the next is that extreme go to 1,000, negative 1,100. That tells me there's building going on. Now, what's happened this week is that the net contracts have gone from a negative extreme number to a slightly less negative extreme number. So it's still in the extreme area, but they've actually reduced their selling contracts. Now that I don't like, because what that says to me is that even though there's still net sellers out there and they're still kind of pushing for downside, they're not as keen at current prices. And maybe what they prefer is a little bit of a rally with the pound, then they're going to get on board again. So it does indicate that if we get signals on the pound CAD to sell, that's what we should look at. We shouldn't be buying. You know, that's one thing it states quite explicitly. When you get extreme area, so there's an extreme area, and then is that extreme area going worse, or is it slightly settling? Is it settling down a bit, or is it getting slightly better, even though it's still an extreme negative? Is it getting slightly better? And I guess you could describe it as a car. A car traveling at 90 miles an hour is fast, but if it's gone from 100 miles an hour down to 90, though 90 is still fast, it is slowing. So we might next assume that there might be another dip rather than it's not accelerating anymore. So we might not sort of if we were betting on a car finishing at a certain time, we might be curbing our bets at that point because it's slowing down. You could think about it as a runner, the Olympic runners, as they slow down towards the end of the race. And if somebody said to us, "Who's going to win now?" we might have less conviction of the ones slowing down and slightly more of the ones that are speeding up, even though they might be slightly behind. So that's really what's going on with the pound and the CAD. So what we would want to see with the pound CAD, if we were going to be trading this on an intraday basis or on a daily basis, is a rally. Now, the rally on this, it doesn't mean we trade the rally because it's still negative, but we're looking for sell signals. The rally on this is going to have to be within this zone for me to be anywhere near interested, between hitting that bottom and hitting the closing support level there. So these bottoms here, the closing support, and you can also see that there is a horizontal level here as well, in and around. So you also want to look at pivots and all that to get an assumption of where this might go. I can see a trend line along here, and we're right on top of it. But because of the COT data, I'm not sure if I'd be that keen. Well, I'd really like to see this get above and go higher, make everybody think that the pound is going to rally against the CAD, and then see if we can sell it off again. And the reason for that is because the fundamental data now suggests that the Bank of England are in a much better position to reduce interest rates. So we should be remaining on the short side for the pound. Seasonal data is not supportive. COT data is supportive, but it is weakening slightly. And the fundamental data is something that we'll look at next. So still looking for shorts, but you know, not in love with the price. I want to see a rally, come up here, and then look for sell signals. So that's always the decision I'm making. Direction first. What's the price that I'm prepared to pay to see if my directional bias is correct? And I'm not prepared to pay this price on a personal note. You might be, but I'm not. Okay, so let's have a look at the fundamentals and see what might be driving the market this week. Is everybody okay, by the way, or am I losing people a little bit? I guess, you know, great. Okay, because all my you're all okay, fantastic. My number one thing all the time is, what direction do I see the market going in? That's number one. Number two, if I am right, what price am I willing to pay to be right, you know, to say I'm right? Now, the reason that I am going to look for the best possible price is twofold. Number one, there might be technical traders in the area that I'm willing to trade. And even though the market might be going in the wrong direction, I may well get a move in my favor to start with. So it means I can move stops to break even. I can take a bit of profit. I can see if the market develops. So that's the reason that the technical area is really important. And the second thing is, if this is if this is more of a buy area than a sell area, it's still likely to go up and then test it. So I'd have a chance to get out. So I got a chance to see sort of things change there as well. Yeah, you're absolutely right, Yasin. Nice spot. Nice spot. So Yasin saying about the head and shoulders. There's the neckline. There's the left shoulder. There's the head, which means that a right shoulder in this area sort of like looks about right, doesn't it? So this might even come down and then come up before there's an opportunity, and it looks complex. And I say, no, it looks all right actually. Yeah, that looks good. Now that would suggest some downside coming, but really I'd like to see a rally, and whether that rally is going to be here to this point, to these lower points here. But this is the kind of box that I'd want to be sort of starting to look for shorts in. 1.6700-ish would be sort of where I'd start looking for sell signals. That'd be my go-to. Now that's only from COT data. So what fundamental data data is potentially going to have the chance to shift this one around this week. Well, let's have a look, because we need a catalyst. Then here we go. So this week, what have we got? Bank of England speech, that could change things. Building permits. Now, now this is the other little thing that I would do if I was sort of in your position where I don't have the current educational level to look at fundamentals in depth. This is what I would do for you guys. Thanks, Gary. That's amazing. So the monthly pivot is 1.72. I mean, that's probably a buy zone anyway. I wouldn't pay that. I wouldn't sell there personally. So this is the way I'd approach it. If I had no experience of fundamentals or very little experience, I don't drag the data off. I'd be looking at this as an example. Building permits has got 2 stars. That suggests it's a bit of a market mover, and it will be if it's extreme. And I would look at the trend. So I'd look at this and I'd bring up building permits, and I'd say over the course of the last year, what's been happening to building permits? Okay, it's up 12.9. This is the extreme here, 24.6. There was an extreme there at 23. Then it's come down. The most recent is a negative print. They're forecasting for a positive print, but the trend here is up and down. You know, there's nothing to suggest that there's massive building programs going on in Canada. It looks like it's pretty much pretty normal. It's normal for it to go up a few months, down a few months, and hit some extreme. So not a lot to see from there. Now here we go. This is going to be important. Average earnings and the employment rate in the UK. If this jumps up, so you get a higher level of employment, that takes pressure off inflation, and inflation's already at 2% in the UK, so that suggests there's going to be a further dip in inflation. The Bank of England are at an extreme level of interest rates in accordance to the last 15 years. So at 5%, people are looking for that to come down to more like 3%. So there's a 2% drop potential with the Bank of England and the pound. So if this pops up, that's going to drive the pound lower. So there's one. Okay, there's one potential driver. Average earnings, that's an inflation number as well. There's another driver. If average earnings excluding bonus comes down, that suggests inflation is curbing again. That should affect the pound negatively. Coming down, I'm looking at the pound CAD. Here we go, the big numbers. Now, when you see big numbers like this, CPI numbers that are after these numbers here, that suggests that any move which is made by traders during these numbers has got a pretty good chance of being reversed. So if unemployment rates comes down, that will settle. That is likely to settle. So what we want to see here is the unemployment rate actually be at least stable, average earnings be at least stable, maybe even pop up. See the pound rally, give us a chance to get into the trade and make an assumption that we're going to be weakening, and then we would look for this, or hope that this would actually give us a reduction in inflation. Now, what they are looking for is a slight increase in inflation from 2% to 2.3%. If that drops anywhere between 2 and 2.2, that will be potentially negative for the pound. Anything under 2 and less is going to be hyper negative for the pound. So this is the inflation data, which is the main event for the week, and it's going to be important. Hot data, as I say, and seasonal data suggest these numbers won't have a big impact this week. Whether they're right, we don't know, but that's what it's saying. So that means be careful, get the right price, and see if you can ride the trade and make your trade safe, potentially before these numbers get released. If you have to trade around these numbers, in my opinion, forget it. Just don't bother. Wait for the numbers to come out and then see if there's an opportunity, as long as it's short, because that's really still the side that we're on with the UK. Now, anything from Canada. So this is a consumer number. That's not a huge mover, but it might do something if we've already seen some negativity from pound. Now, also GDP, this is going to be another thing. So we might see CPI. And this is what I'm looking at. I'm thinking, okay, what days may opportunity arrive? Well, it might arrive before CPI. It might be that the CPI data does tick up and the pound rallies, and then we're looking for an opportunity to see whether the GDP data brings it all the way back down again. So this is how the market is going to be sort of potentially moving around. It might move up from one number, depending on what it is, and then reverse the position from the other. So a pound rally up to our potential price points would be amazing to see before GDP is released. Then we can take a punt on GDP being a negative. Now, anything else from the pound? New motor vehicles, that's not going to be a huge. Retail sales, that'll have a bit of an impact, but it won't be a significant one unless the others are quite benign. And that's it. So really, the pound is going to be the conclusion of that is to trade the pound this week. We need to be aware that we might not get an opportunity until late Wednesday or early Thursday. That may not happen. So don't expect to jump into the market early doors. You might get an opportunity early doors, but don't expect it. Just wait for sort of things to happen and things to unfold. Now, looking at the other prints in the market, the other data points in the market. What else? We got PPI from Japan. So this is inflationary. If we see some deflation maybe from this, some disinflation from Japan, that could weaken the yen further. A little bit of inflation may strengthen it. What else do we have? PPI from the United States. That's going to have an impact on the dollar yen. GDP from Europe, that's going to obviously have an impact. CPI from the United States. This is the big number. So when we may not get an opportunity on the dollar until Wednesday, that's going to stick. Now that doesn't mean that you don't get intraday opportunities, but a move that's going to stick is not likely to happen until Wednesday. And then that move, is that Thursday? That's still Wednesday. Core CPI, big CPI numbers. That move is likely. There's quite a few numbers actually. Retail sales. That number, I mean, per building permits and stuff a little. Oh, and then we got University of Michigan, and well, that's going to give us a little bit of a feed. Now, these later numbers are more likely to have an impact if the CPI number is benign. If it doesn't have an impact, then you look for the next one. But if that CPI number is explicit in what it's suggesting, the next few numbers, as long as they are benign, won't have too much of an effect on the market direction. So you can pretty much stay on board with the direction after those CPI numbers are released, if they are suggestive of something significant. Now, what we're looking for with the dollar is, are they suggestive of a September rate cut? Because if they are not, then there might well be some panic when it comes down to things like the NASDAQ, the S&P, the Dow, and bits and pieces like that. And it might well see some rally with the dollar yen. So this is what we're looking at shaping the market this week. Now, let's just have a quick look at the NASDAQ. Where's the NAS? This one here. Right, now look, the NASDAQ is at a horizontal resistance in accordance to the daily. Let's have a look at it on the weekly. There's our daily horizontal resistance. Ooh, now that weekly is very interesting. So the way I read this chart here is the first thing we got to do is kind of read the longer term time frames. Lovely bounce off the trend line off the weekly. So the dip buyers have bought in right the way up the top. And they've created a lovely hammer here. So that suggests straight away that from last week, the market was risk on. It's positive. Now, so now if we look at this, we'd sort of like make an assumption that there is some more upside this week, because if we sort of compare what this bar tends to do, it tends to suggest buying. But that doesn't mean that we're going to be buying above this bar and going. That means that we take the whole week and the sentiment from last week and bring it forward to this week and say, if we can see the right price, we can take advantage of this. Now, if we look at the daily suggests resistance, which means that the likelihood is that this has got a chance to come down first. Now, if we draw this trend line, that would be a target. That would be a target there. That's the 14th. That would lead us to around about Thursday. Now, obviously, CPI data, everything else is going to affect this. So, if we're going to be taking a position on what the numbers are going to be, we're going to need a good price. No point in trading at resistance. That's silly. But we could see if we can see some support. So we need some carving out here. Now, what's this going to need to do? There's not that much information that is crystal clear when looking at this, except for there was a really nice buying bar Thursday and it held on Friday. But where's support and resistance? Well, the first thing I would do is see if there are any trend lines. There's this one here. That gives me a price to aim at if I want to come down and go long. Change it to the 4 hour. Let's see what that suggests. Right, now this is quite good, because that suggests that there's a horizontal line here as well. So according to this suggests that if the Nasdaq comes down to around about the 1800 level, sorry, 18,000 level, there is an opportunity to look for buy signals. Anything before that, I personally wouldn't be interested. A break of this area suggests we're coming down, and that's playable because we know that the trend on the daily is down, so we'd be with the minor trend to the downside, so that's playable, and it would be playable to the long side here. So that's the way I'd look at the market. Where are we? Where's price? Price is at resistance here. So is there a fundamental reason to go short? Could be. And there could be sentiment. If this starts going short before Wednesday, that suggests that people will sell into the CPI number before potentially bouncing after it. So that's the kind of thing that I'd be looking at from this particular point. Okay, that pretty much wraps up my thinking for the week, which is to summarize, COT and seasonal data suggests effectively no long-term push. That's what they're saying. Now that plays into the hands of intraday traders, because that suggests that some range-bound trading could be possible. And the ranges are effectively saying look for the resistance point and look to go short if the overall market is down. Look for a support line and look to go long if the market overall is up on the intraday levels. COT data is a little bit more clear when it comes down to the pound as a sell and the CAD as a buy. Only a little bit though, because of that reduction in pressure. Seasonal data is not. It's not explicit. Fundamental data is going to be driven by the factors from this week, and that is going to be inflation. It's going to be unemployment, labor market numbers, building permit numbers, and consumer sentiment numbers. Last week's situation will only give us the overall direction of the market. It will not tell us what's going to happen this week. So we need to be able to look at those numbers and suggest and see what's happening with the price action. If you get a selling opportunity on the NASDAQ under this level, it's worth taking. If you get a buying opportunity at this level, it's worth taking. But be aware that the timing is going to be key. Selling here just before CPI is crazy, and it's a silly thing to do. So you need enough gap of time. Selling after the CPI, if you get a sell signal, is brilliant, but you might not get that sell signal because the CPI could drive it all over the place. But you could sell a few days before, maybe even a day before. But by the time that CPI data comes out, your positions ideally need to be safe. Same with the dollar yen. Same with the CAD, the pound CAD. They'll be the sort of ones that I look in and around to this week. Are there any questions, any comments, anything else you want me to look at, which I'll be happy to do before I wrap it up? No, you all okay? Yeah, we can have a quick look at gold. No problem at all. And we can have a look at the euro dollar. Yes, you are allowed to trade that, Ashwin. Yep, no problem at all. Now, the euro dollar is a good one, actually, because the euro is looking a little bit sketchy when it comes down to. Now, this is a really nice chart because the euro is looking a bit sketchy fundamentally. And what we can see here on the weekly, and you notice that I go to the weekly. You can go to the monthly, but the monthly really sort of the information from the monthly would have been at the end of last month. Now we're in the month. I'm starting to look week on week. So what I would see from this is that we've found resistance and we've got a bar suggesting that there's some downside coming. And the European data is tepid, while the US data is actually pretty solid. I'm not going to say positive, but it's solid. So that's the first thing. There was a massive move here, which suggests that there is a gap in the in the orders right the way down to where it had to break out of, which is this 1.824 level, and we're at 1.0915. So there are some pips here, and it's around about a 1-to-1 if you were just to trade the open. Not necessary. You can wait for a proper sell signal. This looks like it's flat to sideways at this moment in time. So you're really looking for some information to see whether we are going to be coming down. But this is definitely an area to look for a sell. So that's the way I'd read the euro dollar. Technically speaking, it looks like a sell. All the data points I talked about earlier on will play a factor. But the euro dollar looks like a sell, and I'd be much more comfortable with that. Cotton seasonals aren't explicit, so be aware that this may well just go sideways. And even though the sell might come, it might not be this week. The gold trade is here. So looking at this on the weekly, I mean, this is effectively, this is in a range. That's in a range, and it is pretty horrible. I've got to be honest that, with something like this, I wouldn't be particularly interested. It's a horrible market to try and trade. If you're an intraday trade and you're basically looking for some buying and selling opportunities on short-term time frames, I can appreciate that. But what you're looking for something longer term, gold looks horrible. Looks more of a sell than a buy on a short-term basis. But you are literally looking at short-term, to my mind. Those US numbers could change everything, but they're going to have to be pretty extreme, I would suggest, to really change this. Because if the CPI data comes in weak, gold is likely to strengthen along with just about everything else against the dollar. But if the CPI data comes in and it's sitting around about the 3.35, then gold could take a little bit of a dip. But I don't think it's going to be a big one. So longer term, I'd still stick with the idea that gold is going to rally. But because of where the current price is, this isn't somewhere I would want to take on a longer term trade. And because the longer term is still long, intraday trading shorts is going to be tough, if not a bit dangerous. So a dip in this one first would get me interested in intraday longs, but otherwise I wouldn't be touching it. Now the euro pound. See, the euro pound is also relatively explicit. Look at how price ended up below the trend line after a really good few days of staying above it. It's just collapsed. Let me just tighten the line up. make sure it is in the right, yeah, that's in the right place. There it is. And it's there. Yeah, price is just below. You know, straight away, technically speaking, to me, this is a sell. Euro pound is a sell. And I've got to be honest, the fundamental data from the UK is actually all right. So I wouldn't be selling the pound versus the euro, you know, at this particular stage. Kind of a ugly looking M topping pattern, which hasn't really played out. CPI data is going to drive this one on Thursday. Does it sell off first? Well, that would be my particular take on it. You know, another big explosive move to the upside. I mean, there's some intraday levels. You know, there's some daily levels that I would suggest are going to be a bit tough to get through. But I think I'd be looking for downside really with this one, unless CPI data comes in weak. If it comes in weak, then I'd expect this one to rally. But remember, because of what the seasonals and COT are suggesting, it's almost saying that it's not, you know, whatever happens to the pound this week is not necessarily the overall move. And it might just be that even though we're looking for shorts against the CAD in accordance to COT data, it may not shape up this week. It might be we get a little rally. The move with the euro would suggest if there's any sort of pound strength, this one would be a pretty good one to play it against. Rather than the CAD, might rally right across the board, but against the euro, it looks pretty good. So I'd be looking for sell signals on this one. And I'd be looking for the economic data on the pound to be less explicit this week than, you know, than we'd really want if we're going to be selling the pound CAD. It might just be that data doesn't, you know, the numbers don't actually reveal until next week or the week after. So the longer term position is short, but it might not be this week. So my take on this would be look for shorts in the euro pound. And then wait for that data. If the data comes in and changes that thesis, then we've got new information. But the probability looks to me like a short on the euro pound. Okay, I think we are wrapped. So yeah, you know, happy trading, guys, this week. And remember that to avoid frustration, you do not have to trade. The market data is already saying this week could be a tricky one. You know, so if you go into trades, then cut yourself some slack and say, fine. You know, it was a tough market. I tried to trade it, which is fine. It's no problem to try and trade it, but cut yourself some slack if things don't work out, because it looks like a tricky market this week. Summer months tend to be a bit like this. We get the odd week. We got lots of economic data. We got COT data, which is undecided. Seasonal data is totally all over the place, except for, well, it's range bound effectively. So it could be a difficult market this week. So cut yourself some slack on this particular week, and maybe even take a week off and do some other work on the charts and the markets instead of trading. That is totally valid and totally fine. You don't have to trade if you don't see anything. If you do, just you know, make a judgment call on how good the signal you believe, how good you believe the signal to be. Right then, I will push off. You're welcome. You're welcome.